Hi, it's Bob. Today I wanted to spend a couple of minutes talking about the current investment environment. The markets have been pretty friendly recently. In the last few days, we've seen the Dow, the S&P 500, and the NASDAQ all hit all-time highs at the same time. This milestone might not be getting as much attention as it normally would because a lot of us are watching coverage of the Olympic Games, and of course we're in the midst of a rather unusual presidential campaign, but that's a topic for another time. If you've been associated with me or our firm for any period of time, you know that we follow a passive investment philosophy when investing our client portfolios, and our own portfolios for that matter. Being passive doesn't mean that we're not doing anything. It simply means that we do not do any forecasting. I've been in this business long enough to know that nobody can predict what's going to happen in the investment markets, so we don't try. We believe that if you're going to try to guess what's going on in the markets, you're gambling, not investing, and we don't gamble with the assets that we're entrusted with. Now, there have been some things I've noticed over the last couple of weeks that reinforces that the way we're doing things is the right way. As I mentioned earlier, stocks have been on quite a roll lately. In fact, the markets have done pretty well after getting past a rough stretch in the first few weeks of the year. We had a brief sell-off after the Brexit vote, but for most of the year we've seen moves to the upside. But recently we've had several high-profile investment gurus calling for gloom and doom and recommending that you get out of the markets. In fact, one well-known expert is suggesting that you sell everything, and another just doubled down on his bet that the markets would turn sharply lower. We think that kind of advice is merely designed to grab the headlines. Now, just like the proverbial stop clock being right twice a day, they'll eventually be right, and we'll get another one of those nasty market sell-offs that are never fun to go through. But those who followed their advice and tried to time the markets would have missed a big move to the upside recently. You see, when you move in and out of the markets based on what you or some guru thinks, you actually have to make two decisions. The first decision is when to get out, and then once you're out, you have to decide when to get back in. That type of strategy almost always results in buying high and selling low, the opposite of what you want to do when you're investing. And it gets worse when you let the emotions of fear or greed creep into your decision-making process. Also, when you're actively trading in or out of the markets or individual stocks, you have transaction costs and potential tax consequences that can act as a drag on your portfolio. We believe that the best approach is the boring approach. We follow an investment philosophy that is rooted in Nobel Prize-winning academic study, and we stay disciplined. Through good markets and bad, we stick with our strategy. When we get a run-up in the markets like we've enjoyed recently, we'll sell a bit of those asset classes that have gone higher and buy some of the ones that have gone lower to make sure that our portfolios always stay balanced. Buy low, sell high. That's the way it's supposed to work in the investment world. Thanks for watching. Now, let's all ignore those gurus and go back to enjoying the Olympic Games.